Hello again, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles and Cycles TV. Good to be with you again for another week. Another week has transpired in the markets. We know a little bit more. We got our 25 basis point cut from Mr. Powell and the Federal Reserve. Since we last were together, it was Tuesday last week when we were together last, and then the Fed meeting was on Wednesday, and we got the 25 basis point cut in the conference and a rally since then, right? So we got the cut that we were expecting. So far, the market seems to be expecting more cuts. Right, we saw the new Fed governor, Stephen Myron, and saying should have cut 50 basis points. It's kind of a indication of what Trump's policies are, what he would like the Fed to do. And the market seems to have taken it as more cuts ahead, whether that's from political pressure or genuine economic reasons for more cuts ahead. Don't know. But the overall response has been there's going to be more rate cuts. And that has led to a rally in asset prices. So whether or not it's sustainable, we'll see. Today, I'm going to do something a little different and dig into the plumbing of the global financial system and the Federal Reserve in particular in some hopefully not too painful detail. But I think it's very important that we really understand what's happening here, how it works, because we're trying to ultimately be aware of when there are major changes, particularly in asset price trends. And my big thesis continues to be that we are in the late stages of a big debt cycle, that those are typically 80 to 100 years long. And then within those big debt cycles, we have smaller cycles, business cycles, liquidity cycles. I've been focused on the liquidity cycles. I've been interested in Michael Howell's work from Capital Wars and Cross-Border Capital. And I think that this particular liquidity cycle that we're in right now, 65 months, 5.5 years, 5 to 6 years, right, is particularly important because of where we stand in the big debt cycle. And there's a lot of debt in the US government. 34 trillion, I think, was the last estimate. I have no idea what that number even means. $34 trillion, right? A trillion is 1,000 billion. So that debt is really dominating the financial system. And we're going to start to understand why that debt is so important and how it really drives the global financial system overall. So we're going to get into that. It's going to take a while. We're going to go through it in detail. We're going to try to really understand what's going on, because what we're looking for ultimately are triggers that are going to indicate that something is changing systemically and that we can, get out of the way of in a timely manner. So going to ask everybody's patience today as we get into some detail. This is almost going to be like an economics lecture with some cycles analysis at the end of what I think might be things to watch out for systemic changes in the system that we're living in right now. So with that, I'm going to dig into it here. Thanks for joining me today. As you have questions, put them in chat. I'll try to get to them as we go along. And without further ado, let's get started. All right, so I've actually covered my thesis already that we're in late cycle dynamics and liquidity is more fragile during the late cycle dynamics. These debt cycle amplifies the liquidity cycle. And collateral repricing risk is the key trigger that I think we should be on the lookout for, because that's what changes the direction of the liquidity cycle. We'll understand that in 30 minutes or so. And then we can start to look at some indicators of what might help us see those early warning signs, right? So what is liquidity? It's the ease with which assets can be exchanged for cash without moving their price, right? So the US equity markets are very liquid, right? We can buy and sell stocks, especially large cap stocks, for very small spreads, like a penny between the bid and the ask. So liquidity is basically the ease with which assets can be exchanged for cash without moving their price. And there's 3 tiers of liquidity: market liquidity, how easily assets trade, right? You can trade treasuries, you can trade futures, you can trade equities, and how easily those assets trade is the market liquidity. There's another type of liquidity called funding liquidity, how easily financial institutions can borrow against collateral. Okay, so if you have a mortgage on your home is collateral for the bank lending you money, right? Well, guess what? Treasuries, if I own treasuries that I bought from the US government, I can use those as collateral to borrow money from others. Why would I do that? I'm buying treasuries from the government, presumably to earn interest, but sometimes maybe I want to loan those treasuries out to get some cash. So that's how it works. That's funding liquidity, not just your home securing your mortgage, but treasuries securing loans of cash. So, and then there's systemic liquidity, availability of collateral and cash across the global financial system. And that's driven by Fed policy, treasury issuance, and capital flows. So all of this is part of the global liquidity system. So back here, we have the word repo. And repo means, so we got to talk about repos. So a repurchase agreement, that's the word repo. It's essentially a secured loan. A borrower, usually a dealer or bank, sells treasuries as collateral and promises to buy them back later, typically the next day at a slightly higher price. Okay, so the Fed has a repo window. I think it's called the standard repo facility. We'll get into that. Where, let's say, a bank can say, hey, I got these treasuries. I'm going to sell them to you, actually. Okay, I got $100 million of treasuries. I want to sell them to you for $100 million of cash, but I'll buy them back from you tomorrow. I'll repossess them for $101 million. So 1%, I guess. That wouldn't be literally an overnight rate of 1%, but that's the idea that's what a repo is. You say, I'm going to get cash from you by selling you my treasuries, but I'm going to buy them back from you tomorrow. I'm going to repossess them tomorrow at for a higher price than what I sell them to you for. So that's what a repo is. And that's one of the big functions of the Federal Reserve, to provide those repo facilities so that those who hold treasuries can turn them into cash and vice versa, right? So that's why the dollar and treasuries are so almost identical, right? So treasuries are easily converted into dollars and vice versa. So that's why treasuries and dollars are so critical to the liquidity of the global financial system, okay? For the lender, it's a safe way to earn interest. For the borrower, it's a way to access short-term liquidity. So the reverse repo facility is different than the standard repo facility. With the Fed's reverse repo facility, okay, I don't know why it's called P, But money market funds and other institutions can park excess cash with the Fed overnight in exchange for treasuries. So it's the other direction, right? So money market funds can say, hey, I got all this cash. I'd like some treasuries overnight so I can earn some interest. And so that's the reverse repo facility. So it's not the same thing as banks giving treasuries to the Fed and getting cash back. This is money market funds and sometimes even banks giving cash to the Fed and getting treasuries back. So interesting how cash and treasuries are so exchangeable, right? Practically fungible. So this is why treasuries are almost like dollars. So the reverse repo facility drains liquidity from the system, right? So if there's too much liquidity, then that cash goes back to the Fed and they give out treasuries. Used heavily during QE when there was too much cash sloshing around. So the standing repo facility, that's what we already covered, right? Banks and dealers can borrow cash from the Fed against treasuries. Provides an emergency backstop of cash into the system, right? Ensuring treasuries remain usable as collateral even under stress. It was created after the September 2019 repo crisis. Not sure why that happened. There wasn't a particular global event that triggered this 2019 repo crisis, but repo rates spiked to 10% because reserves had fallen too low. All right, so far we've covered the basic idea of what a repo is and how the Fed has kind of a two-way facility, one where banks can give cash to the Fed to get back, give treasuries to the Fed to get back cash, and the other one where money markets and other holders of cash can give cash to the Fed and get back treasuries. So the SOFR, or the secured overnight financing rate, maybe you've heard this term. We're going to actually understand what it is today. So the SOFR is the benchmark rate that tracks the cost of borrowing cash overnight in repo transactions collateralized by treasuries. That's what the SOFR is. It's how much the Fed demands in interest, okay, on those treasuries to give you cash. It's the broadest measure of repo rates in the US. Okay. Importantly, this is not the same thing as the Fed funds rate. Okay, the Fed funds rate is the unsecured interbank rate, what banks charge each other for reserves overnight. Okay, but the SOFR is different than the Fed funds. The SOFR is what you're going to give your treasuries to the Fed overnight, and you're going to buy them back the next day, and you're going to get cash. But in the meantime, the Fed charges a certain rate. You got to buy those back at a higher price than you sold them. That's effectively what the SOFR rate is. So it's the rate at which the Fed demands to give you cash in exchange for your treasuries. So it's a little different than the Fed funds rate. Woo! So we are really getting into the weeds here. How they fit together, right? The Fed funds rate is the policy target. That's what they just lowered by 25 basis points. The SOFR is the market reality. It shows what repo participants, which we know what that means now, actually pay to borrow against treasuries. And then the reverse repo absorbs excess cash, putting a floor under repo rates. And the standard repo facility injects cash when there's stress, putting a ceiling on repo rates. So that's the picture of kind of how the plumbing system works with US dollars, treasuries, and the Federal Reserve. Now, why does this matter, globally to financial markets? Well, because the US dollar is the world's reserve currency. Everything's priced in US dollars, oil, copper, etc., right? So if you want to buy oil, you want to buy copper, and you're a foreign government, let's say, then you have to buy those things in dollars, and you got to have dollars in order to buy them. Numeraire means what things are priced in. I had to look it up this morning. I didn't even know what numeraire meant, but numeraire means the unit that things are priced in. There's our vocabulary word for the day. Okay, so USD and treasuries as numeraire, right? So the US dollar is currently the global reserve currency, meaning many important things are priced in dollars and you have to have dollars to buy them. And treasuries are the world's core collateral. We just saw how easily treasuries are exchanged for dollars and vice versa, particularly through the Federal Reserve. That's why treasuries are so important to the global financial system, right? So if we think of like the example of the US and China, China wants to buy oil, China wants to buy copper. They're priced in dollars. How does China get those dollars? They make stuff and they sell it to us and they get dollars in return. So now they've got a bunch of dollars over in China. What do they do with those dollars? Well, the dollars aren't earning interest, so they want to buy treasuries with them to earn some interest. Those treasuries are now on their books, right? And they can use those treasuries as collateral to turn them back into dollars when they need to for different durations. So that's the basic give and take of why treasuries and dollars, what role they play in the global financial system. And they're very linked together, right? Similarly, we've talked about US banks, wanting interest on their deposits, right? They have a bunch of deposits, they want interest. They might buy short-term T-bills, for example, to earn some interest. But they got to keep their balance sheet liquid, because if people come in and want their cash back, they got to have it and be able to give it back to them. So that's the basic idea of the role that US dollars and treasuries play in the global financial system. We've talked about the federal debt expansion, right? The reserve roll enabled massive US government borrowing. China's got all those dollars and they want to buy treasuries with them to earn interest, right? So the government just makes more treasuries and sells them and gets the dollars back. So this role of the United States as the world's reserve currency has made it very attractive for others to make stuff and sell them to us and get our dollars so that they can buy stuff and then they buy our treasuries. And that whole thing is kind of on shakier ground right now with this deglobalization that is happening as we speak. So the federal debt now 34 trillion and climbing. So you can see how these cycles, right, become more problematic. So as the US government goes more into debt, more people want to buy our debt so that they can earn some interest on all the dollars they have. The debt goes up. And then at a certain point, we don't know when it is, the world starts to go, well, that might be too much debt. I'm not sure that the US government is going to be able to pay me back. So therefore, I might not be willing to buy as much debt from the US government because the debt's gotten so big that I'm not sure I'm going to get paid back. Then the price of that debt starts to go up, right? If there's less demand for the debt, the price starts to go up. But here's the clincher, right? All these other countries and banks and institutions already hold a lot of that debt. So as the price of that debt goes up, all the debt that they hold that is being used as collateral, that becomes in question. And this is how debt cycles and liquidity cycles work. It's when, gradually the role of the collateral expands. At a certain point, the collateral funds so much debt that we start to go, I'm not sure this is such a great bet anymore. And then that starts to increase the price of the collateral because of the volatility of the collateral. And we'll talk about that in just a minute, right? So treasuries underpin that global leverage. We've got Dalio's big debt cycle. We've talked about that. We're currently in a phase of fiscal dominance. That's the late stage of the cycle. What does fiscal dominance mean? It means that the fiscal needs of the US federal government dominate the capital flows. Okay, so if the US government has to borrow more and more money, every year because of the deficit and because of now the cost of servicing the debt, okay, then they're soaking up a lot of the capital in the world, and it's going into essentially funding the US government. That's fiscal dominance. And that is what happens in late stages of the big debt cycle. And that is where we are right now. Okay. Servicing debt drives fiscal and consequently monetary policy. We see that right now, right? Why does Trump want the interest rate down? Because the fiscal needs of the government demand more liquidity from the Federal Reserve to bring down interest rates and lower the servicing costs of the debt of the US government. So fiscal policy begins to drive monetary policy. We certainly see that happening in real time right now. That's what's going on. Okay. So meanwhile, then there's this 65-month liquidity cycle. The global liquidity cycle, which this absolutely fascinates me. We talked about it last week too. We had Michael Howell with us in our master working group last week. It's fantastic. And he put this cycle together in 2000, back about here, right? So all this stuff from here forward is out of sample, right? This all was predicted back in 2000, including this latest iteration of the cycle, the black line there overlaying the red line. How perfect is that? Predicted, 18 years ahead of time. And of course, this is even a little out of date. I think already we're past the peak of the cycle. Doesn't mean, it's going to peak immediately, but the liquidity cycle is 65 months. We're in the late stages of the big debt cycle, the fiscal dominance stage, where fiscal policy starts to drive monetary policy. So what we're looking to do right now is try to shift this, liquidity cycle out a little bit, get a little more time of increasing liquidity. That's what the Trump administration is trying to do. So give these new policies time to take hold without the constraints of tightening liquidity. That's where we are. So now that we know that, we can start to understand the relationship between collateral pricing and liquidity. So tight spreads, right? We define liquidity in the very beginning of our presentation as the ease with which you can buy and sell things, right? That's tight spreads. If the spreads are tight, it's easy to buy and sell something. It's more liquid. Simple as that, right? More liquidity equals more leverage, okay? If, my home is worth $1 million and I want to go borrow money from the bank and use my home as collateral, then if I can buy and sell my home quickly, right? If the bank says, well, if we have to take possession of that thing and we can buy and sell it quickly, we're not as worried about getting our money back. But if we can't buy and sell it quickly, then we are more worried about getting our money back, right? So we can think about it as a mortgage, right? But it's the same thing with regard to other collateral. And the biggest collateral in the world is US Treasuries. So as you get more leverage, right, you get too much leverage at a certain point. Like, is 34 trillion too much debt? Is that too much treasuries floating out there, right? Too much leverage in the system? At some point, we don't know when, right? We get these widening spreads, and the widening spreads trigger a deleveraging, right? We're going through global deleveraging right now. And deleveraging means the price of that collateral, the value of that collateral, how much cash it can secure isn't the same. A lender who's got collateral, holding collateral, if that collateral becomes harder to sell, more risky, it's not going to secure as much cash. And those are called collateral haircuts. And that's what we're looking for. Collateral haircuts ultimately drive less liquidity. Okay. So that is the big picture. Let me stop for a minute here before we start to dive into some indicators that we can track that would help us identify when these cracks in liquidity and collateral, okay, which drive liquidity right now, might start showing up. That's what I'm interested in, and that's what I'm starting to track myself to understand, where we're at really in the liquidity cycle, because I think this liquidity cycle is going to be more risky given where we're at in the big debt cycle. All right, Kevin, when H4 cycle projections show a peak on September 26th, but the daily projects a trough the same day. I'm not sure what H4 is, Kevin. So maybe you can share a little bit more about that on the comments in YouTube, or send me an email, richard@cycles.org. And I'd be interested in learning more about it. In fact, I'll look it up more after our session today. Bill, when the Fed issues repos, they are injecting cash into the system. Exactly. Thank you. What is the impact of a declining dollar on bonds sales and the ability of US to finance the debt? Yeah, that's a great question. So as the dollar declines, so China, gets more dollars from us, but the value of that dollar declines. And so they can't buy as much with those dollars. I'm not sure if that includes not buying as much bonds. So that's an interesting question, Bill. I thank you for it. Both Kevin and Bill, these are good questions, and I don't have the answers for them right away, but I'll look into them and try to understand them better, and we can talk about them next week. All right. So now you see my big picture hypothesis here. And I'm going to bear with me for just a little bit more to now talk about what are some indicators that we could watch. So I didn't know about these before I really started to dig into them. So there's something called the SOFR IORB spread. So I know there's a lot of detail on this slide. Don't go to sleep on me. The SOFR, we've talked about it, right? That's the rate that you got to pay the Fed in order to turn your treasuries into cash. The IORB, the interest on reserves, balances the Fed's risk-free rate paid to banks on reserves. Okay, so basically the SOFR is what you have to pay to turn your treasuries into cash, and the IORB is what you get paid just for your cash. So if SOFR gets above IORB, that means that collateral is more valuable than cash in the short term. That means there's some pressure that is increasing the value of the collateral, right? And making collateral, more precious, which means that people want to get their hands on the collateral and not the cash, okay? Which means that there's some stress in the collateral market. So the SOFR IORB spread is telling us as a warning system, if SOFR gets above IORB, that means collateral is getting more precious. The kind of demand for collateral is going up. And ironically, that means the spreads are probably going to widen. So it's an indicator of pressure on collateral. All right, so here is the SOFR minus IORB spread. Here today, we are at September 19th, right? So this is a few days old. And we can see that SOFR is a little bit below IORB. We want SOFR to be below IRB. It's an indicator that cash is still safe, and which means more liquidity. And right now, there is a pretty clear cycle, this 226 period cycle right here. Okay, stability is 68. And we can look at so this going down, right, in the cycle would mean that liquidity is still okay, because it means IORB is going up in value relative to SOFR. Don't know if the cycle is really going to forecast it or not, but on the whole, I like the way this is going, and it suggests that liquidity is not really in imminent trouble, at least as far as the cycle is concerned. There's a 21-day cycle here, which is interesting. That's got to be the month, right? 21 trading days is basically a month. So you see this kind of tension between assets and treasuries and cash at the end of the month, at the end of a quarter, etc. So that's why you see that 21-day cycle. So that's interesting. SOFR still kind of not under a lot of pressure. Cash is still plenty available. So that suggests liquidity is not on the verge of going away. All right, our next indicator is the MOVE index, or bond volatility, right? It's like the VIX for bonds, particularly treasury matters. Why it matters? Higher treasury volatility means repo lenders demand bigger haircuts on treasuries, right? You can't get as much cash for your treasuries. And if you've used your treasuries as collateral, your lenders are going to come and say, you know what, that collateral is not working for us anymore. We need a little more. We're not going to loan you money to refinance at a minimum, right? And maybe we'll even try to renegotiate your loan. So that would create problems with collateral, which will create problems with liquidity. This reduces the amount of leverage that banks and hedge funds can run, shrinking systemic liquidity. Collateral volatility equals liquidity risk. Spikes in MOVE often lead equity credit stress. So where are we at with the MOVE? Here we are. So this is the MOVE index. We've talked about this. Lars did a great show on it. We've had this phenomenal move down in the MOVE index. This has basically been why we've had such a rally since April, right? When Trump backed down off of his unilateral tariffs. This reduction in bond volatility has meant that collateral of treasuries gets you more cash. Means more liquidity in the system, means more money to buy stocks, crypto, whatever you want to buy, right? So this decrease in bond volatility means more cash that you can get in exchange for your treasuries, which means you can buy a lot of stuff with that cash, plenty of liquidity. And that's essentially what we've seen. I did this just as out of sample here to show that our cycle forecaster did a pretty good job of forecasting the turn down in the MOVE index. Meanwhile, if I incorporate all of the latest data, see where we are in the cycle. If we incorporate all the latest data here, these two cycles, 127 and 163, certainly stick out. We're clearly beyond the bottom of that cycle. Meanwhile, the index still trends down, and the momentum, the CRSI, is not showing imminent danger. But I do think that this cycle is very strong, and it's a concern. It's a red flag, even though the momentum is not really indicating big trouble yet, although we do have a slight positive momentum divergence here. If we drill into this a little bit, right? The momentum here was lower than it is here. No, actually not. They're about the same, I would say. But we have a new low in the move index without really a new low in momentum. So I'd say this is a big concern. If we see treasury volatility really start to pick up for some reason, I think that would definitely reduce liquidity, to reduce the available cash, which could buy equities, crypto, etc., which would be risk off. All right, so just a couple more indicators here. High yield option adjusted spread. This is something that's actually tracked by the Federal Reserve. And high yield debt, right, means that the debt that is secured by collateral that's not as safe as treasuries. And so therefore, it's kind of an early indication of when we might expect stresses in the collateral system that's ultimately protecting the balance sheets of those entities like the government that need to borrow money. So the high yield option adjusted spread, the extra yield investors' demand for holding junk bonds over treasuries, right? If that widens, when that does widen when investors fear credit stress or liquidity shortage, okay? So we can look at that. Again, this is something that's tracked by the Fed. I just got this using our link to the Fed system. This is the ticker right here, :FDS for Fred. And so we can see, much like the move index since February, this has gone down dramatically. And it's still going down, okay? So all those who think that the market's going to top today, good luck, because we see liquidity growing from both the move index and the high yield option adjusted spreads. They're still coming down. Momentum's going down. Yeah, the cycles are pointing up, but you know what? The momentum is not. So both the move and the high yield OAS are suggesting that liquidity is not about to evaporate. It's not under stress. Let me just stop this now, go back here. Liquidity is supported by collateral. And the easier that collateral can be bought and sold, the narrower the spreads are, the more you can borrow with that collateral. So we don't see stress yet in the move index that basically tracks the volatility of treasuries. And we don't see pressure in the high yield option adjusted spreads. We do see cycles, but right now those cycles, aren't having a big influence, and momentum continues to trend down. So that's the big picture. I've got some more indicators that I'm looking at to develop this early warning system that could help us really time when the big debt cycle and the current liquidity cycle are going to really become a problem. So right now, I don't see that they're a big problem. What was the first one that we looked at? The SOFR minus IORB, right? So not a problem there. Not a problem with the move index, and not a problem with the high yield OAS. Cycle suggests there could be a problem, but so far, momentum and the CRSI are not confirming the cycles. So that's it. That's how it all works. This era that we're in right now, where the fiscal dominance is really driving the capital flows. It's different, than when it's really savings and productivity increases driving the capital flows, right? People aren't taking their money and building new factories. It's really about how do we keep refinancing and make sure that we've got enough cash to stay alive. So that is the situation that we're in right now. There's another topic of how debt and treasuries are monetized, but it was too much to get into this week after hitting you with all this heavy stuff already. So let's see if there's any more. Why would they buy bonds if the asset is deteriorating? Good question, Bill. But the bottom line is, I think it's really about whether or not you can buy bonds right now. They're not looking at it going, the government's in $34 trillion of debt. Why would I buy bonds? No, it's like, are others still buying bonds? Then I guess I'm still going to buy bonds. That's where we're at right now because it's become so disconnected from reality. $34 trillion of debt, right? It's like nobody even knows what that means. So we're living in a fictional reality right now, and it's really about what's your neighbor doing. And if he's doing it, I guess it's okay too. But that creates a very tenuous, brittle dynamic where if all of a sudden a lot of people start to say, you know what, I'm not sure this makes sense anymore, then we get the proverbial, running for the exits and trampling, etc. So that, I think, is the risk that we have. Meanwhile, we're not there yet. Liquidity is still abundant. We know what the relationship is between collateral and liquidity now. We've got some early warning indicators like the SOFR IORB spread, the MOVE index, and the high yield option adjusted spreads, all things that economists and institutions track. And all of it is has cycles, good cycles, right? It connects with the 64 to 65, 7-month cycles in unemployment and inflation that we've been tracking, and the 65-month liquidity cycle. So it all ties together. It's the best thing I know to do, to look at, for the big question that we all have, which is, when does the blank hit the fan? And I don't see it yet. So thanks, everybody. Appreciate you sticking with me and digging into these details with me, being people that really want to understand how things work and how the cycles come into play and what they can help us do and not do. So thank you so much. If you appreciate our content, please do make sure to tell your friends, family, and bring them into the Foundation for the Study of Cycles. Make sure you're subscribed to our channel and that you like our content. And with that, I will see you again next week. Thanks.